Hey, everybody. Welcome to PFA's fourth quarter halftime report. My name is Sam Chaplin. I am joined, as always, by our fearless leader, James Bradley.
Hi,
Come on,
everybody.
Jim.
Thank you very much for letting me join you again, and happy December, Sam.
Happy December. Hope everybody had some good family memories there, eating Thanksgiving dinner. We are going to jump in today, reviewing what's going on in the economy, the markets, talking a little bit about AI at the end. Jim's going to lead us off here, looking at our economic scorecard.
Yeah, if you watch our content on a regular basis, you might get used to seeing these 12 indicators that we look at generally on a quarterly or even a monthly basis. And what we've got here is a layout of these 12 indicators that generally give us an idea as to where the economy is heading. Is the economy set up for expansion? Is it set up for recession? Or is there just kind of caution signals flashing? And right now, with a little bit of a asterisk, I would say, we are still flashing an overall signal of green, indicating that there's expansion expected. I say with an asterisk because unlike what we saw in June and what we saw in September, you'll notice that there are some missing pieces to the range of indicators that we have. And that, not terribly surprisingly, comes from the fact that the sources for these were government sources, and the government was shut down for a fairly significant amount of time up until recently. But just in general, we're looking at a situation where only one indicator is flashing red. Once these do fill in and we start to get a more complete picture, we fully expect for there not to be a lot more additional red recessionary signals to join job sentiment. And we expect for the overall signal to remain green. Little change in September with some improvements in manufacturing orders, and that offsets a decline in housing permits, which is a fairly positive indication. And keep in mind, we don't miss all of the data that we have for this particular month, because not all of the data that we utilize in looking at the overall direction of the economy really needs to come from the government. A lot of these come from private companies, payroll companies, spread analysts when it comes to the measurement of what we're getting for credit spreads and money supply and that type of thing. So we've still got some degree of indication. But the problem is when we look at what the Fed has to do when they're making their decision as to what happens next, they're also working with a little bit of a dearth of information. And that's going to make making really substantially convicted changes from the Fed's standpoint that much more difficult. However, at its base, looking at the chart here, unemployment continues to tick kind of sideways, maybe a little bit higher, which is something that the Fed would look at as an opportunity for them to swing in and help with potentially continuing to cut rates, whereas consumer prices are stubbornly staying well above the 2% target that the Fed has. And that would kind of work against the Fed making monetary accommodations that much more easy. So what we're looking at is a Fed that's, frankly, if you're watching this in the first part of December, we'd be kind of surprised not to see a quarter point cut in the Fed funds rate on December 10th when the Fed gets together. But after that, I think it's just about anyone's guess. And so we're going to be watching carefully to after the Fed rate decision next week to see what the Fed chair actually says and gives us some context there. I'm going to throw it over to Sam to talk about some of those components of the inflationary picture that we're looking at.
Yeah, thanks, Jim. We've been focusing on this a lot because there's really two big things driving market performance right now. One is interest rate expectations. The other is AI demand and build out. So we're focusing on the interest expectation side right now. And what's, really startling about this is we've hit this part where unemployment rate is rising. Inflation is falling, but kind of stubborn, putting the Fed in a difficult position. Do you cut interest rates to spur the job market, or do you keep them high to make sure inflation remains under control? And they've lost visibility because we didn't get as much data out of the government this past month or two. And then what's important for us to do now is to dig into the components of inflation to try to get an idea, is this going to be persistent into next year? So the Fed's not going to be able to cut rates, or do we expect it to continue moderating in the coming year, allowing the Fed to cut rates and support the labor market? So looking here at this graph, we're looking at core goods, shelter, and services inflation, and you can see what percentage of the CPI they are there. But what's interesting is that we have seen, goods inflation after we really had everything inflation following the pandemic. Goods inflation came down after the supply chains were fixed. Shelter and services were much lower to reprice as we expected because they're not quite as dynamic, but have gotten back to near pre-pandemic levels. The interesting part we're seeing here is that goods inflation has started to rise a little bit. Now, some difficult to calculate part of that has to do with tariffs. So tariffs is something we're going to focus on here for a few as well. But interesting to see that while services inflation and shelter inflation has gotten back to where we want it, we're starting to see some concerning signs on the goods inflation side. So when we come over to tariffs on the next slide here, we're going to see that cumulatively year to date, the data we had through the end of August, we had seen $93.5 billion in tariffs. So those are taxes being placed on U.S. importers to bring goods in out from outside the country. And there are some challenges in court now to see if these tariffs are going to be held up and remain legal. Because really, constitutionally, tariffs are supposed to be a power of Congress, not the president. The president's only really supposed to be able to use them in real emergency situations that are very targeted and specific, not necessarily the blanket tariffs that we saw rolled out back on Liberation Day in April. So this is going through the Supreme Court. Kind of a coin flip on which way it'll work out. I'd say consensus lately has been moving further towards the side that these tariffs will be called unconstitutional and may need to be returned to the importers. So while that's a logistical nightmare, it would have some pretty big impacts on the market. These were mainly U.S. corporations who paid these tariffs to import. So giving that money back to them will increase their profits. That's great for company performance. However, on the other side, this has got now money that the government won't have to fund their spending, pay down debt, anything like that. So that creates some more risk on the governmental side. So this is something really big to keep an eye on, making it even harder for the Fed as they try to project forward, because they don't know how long these tariffs are going to last, if they're going to continue pushing inflation at all, whether they could be gone in a few weeks or months. It's in oral arguments right now with the Supreme Court, but anybody's guess as far as weeks or months until we get a decision on that. But the longer it goes on, the more this bill grows over time and the more impact it'll have on markets when the decision does come down.
I guess it's not as hard to withhold candy from a baby as it is to take candy from a baby. Not how
Agreed.
Children. I'll let you weigh in on that because you're the Well, yeah. So, with all that being said, with, goods inflation starting to come back up and uncertainty about tariffs and everything, one of the things that, a lot of clients that I sit with certainly are interested in is whether or not we're standing at the edge of a cliff or a bubble or what have you. First of all, as we kind of mentioned before, indicators are showing us that we're not necessarily looking at the type of range of indicators that would be consistent with the start of a recession. And another way to look at that is when we look at U.S. corporate profits. Corporate profits, especially for a subsection of companies, are really actually hanging in there quite well and accelerating to the upside. And we looked at this maroon line that drops down as a part of where recessions typically start. Where they've started in general is midway through a relatively substantial decline in corporate profitability and or corporate profitability growth. So it's worth noting, though, that the earnings growth that we're seeing right now is frankly concentrated in not a whole lot of companies. If you look at the S&P 500 as an example, 10 of the companies in the S&P 500, which tend to be the largest of those companies, make up for a lot of the earnings growth that we're seeing. It's not that there's no earnings growth in the other 490, but they're more in line with longer term norms, whereas these 10 are growing at relatively high rates of speed. And if we look at valuations on the U.S. market, that actually shows in higher valuations for the 10 largest companies. And valuations that might be a little bit extended, but are frankly a little bit more in line with norms for the other 490 companies that make up the S&P 500. And this is important because it drags the average valuation of the S&P 500 up fairly significantly. Even though it's just 10 companies, keep in mind that the S&P 500 is market cap weighted. And what that basically means is that these 10 companies, and you know the names, Google, Amazon, Apple, Microsoft, Nvidia, etc., these make up almost 40% of the weighting in the S&P 500. So when they have high valuations, that's going to drag the rest of the market's valuations up with it. So it's good to look at this kind of separation between those high flyers and the rest of the markets. But one thing that clients really kind of focus on is the fact that when have we seen this before? When have we seen a situation where big companies, tech companies especially, have been relatively expensive? And the answer is we look back to 2000, 2001, 2002. In other words, the dot-com bubble. This is a similar dynamic that we saw back then. So obviously, investors ask very prudently, is this the sequel that we're living through? One of the things that I will point out is that, before we even go into some of the more fundamentals, is that when we look at valuation multiples, we're essentially looking at what we're paying for earnings. So if we kind of flip a valuation multiple, or what we're earning for what we pay, which is an earnings yield, these numbers are relatively in line with what we'd see on a risk-free investment, like a 10-year Treasury note. 10-year Treasury note yields about 4% right now. Depending upon whether they're looking at the largest or small or other numbers here, these would equate to earnings yields of 3 to 5%, which kind of falls in line. We should get a better earnings yield from equities or stocks than we'd get from a risk-free number. So that's what makes us think that we're a little extended here. But by comparison, there's really no comparison with 2000, when we were jumping over 40 times earnings, or current earnings in this particular case, which equates to about a 2.5% earnings yield. And at the time, the Fed funds rate and the 10-year Treasury note were all above 6%. So way less difficult to justify those valuations, a lot easier to justify valuations where they are right now. Adding to that, when we look at the profitability that these companies are generating, you might think back to the dot-com era. One of the jokes was that all these companies were just going up in value, and that it was almost a kind of a negative to say, oh, we've got great earnings, because earnings were a future thing. We were talking about, oh, it's okay. Earnings will come. This is life-changing, this new internet. And once these companies start to take off, they're going to take off big time. So not a lot of the companies had the earnings to justify their valuations. And right now we're looking at actually higher profitability, especially in these tech companies that we're looking at. 32% growth rates relative to 20.5 back in March of 2000. At the same time, much lower valuations relative to what we were seeing. Again, if we just peel off the tech companies, about 40% lower valuations instead of over 50, just about 30 on the valuations that and the PEs that we're seeing over the course of the next 12 months. So this is definitely not an exact replica of what we saw during the dot-com era. Paying lower valuations for higher growth means today's price levels are more justified than those of the dot-com era. And doesn't mean that the market might not still be a little bit over its skis and a little bit overvalued, but we just don't think that there's any real comparison to be made to 2000. Sam?
Yeah, thanks, Jim. Another chart that's been going around we're looking at here, looking at circular financing, and it's been another way clients have been looking and wondering, this looks like an echo of the dot-com bubble a little bit, like especially how they built this chart out. It looks very bubbly. But what this basically is companies investing in each other within the ecosystem of AI. You could think some of these companies make chips. Some of these companies build large language models. Some of these companies provide cloud services. So they all very much need each other to work. It's not one company building AI and deploying it to the world. If this build out is really going to happen at the scale that they want it to happen, they need to have their footing in there. They need to be in their industry and have partners that are going to help them get where they want. So you see a lot of this funding where, NVIDIA invests 100 billion in OpenAI. OpenAI commits to buying a lot of their chips, and then OpenAI also invests in Oracle to make sure that they get their cloud services. So all this is about trying to make sure these companies are going to have the capacity in the future to be able to maintain the future that they want to see for their company. So that's not totally uncommon. Technological revolutions of the past, especially in the early days, these companies look to invest in each other to make sure that they can have a sustainable advantage and grow the way they want to. Something a little unique about this cycle is that a lot of these companies are already huge and have massive cash flows already. So they're not financing this with debt in many cases. Some of them are, some of them not so much. But you can think about technological revolutions in the past as often a disruptor coming out of left field who's not really part of the industry, who's trying to break in. They don't have a lot of cash flow, so they're taking out extreme amounts of debt to fund this future. And if that future doesn't work out, they go under very quickly. These companies are different in that they have massive cash flows. I think, Google itself has almost as much cash on its balance sheet than OpenAI is worth, like hundreds of billions of dollars. So they can afford to make these investments and lock in their future. And then the other part I want to point out here is that, like I said, this can happen early on in technological innovation. So some of the funding is not being or some of the valuations is not being driven by the end user necessarily, like you and I are using AI right now. A lot of it's being driven by these internal, transfers of wealth. And sometimes it just feels like they're playing a game of who can say the bigger number. And right now, I would say some of these companies are saying some pretty big numbers, and it's going to rely on the end user eventually coming into play and really demanding. So right now, we really have the demand for these chips and cloud compute and large language models really outstripping the supply. So there's not an issue of the oversupply and now all these people are going to be canceling their orders. We're nowhere near that right now. You can see in NVIDIA's latest earnings reports, demand is just as strong as ever. So if we do start to see oversupply, companies canceling orders, that's when we can start to get concerned. But again, these companies have a lot more of a buffer where they can stand some of those canceling of orders than maybe technological revolutions of the past. So that was a quick touch on the circular financing. And I also want to point out that this is not vendor financing, which was a big component of things like Enron and the dot-com bubble, where companies were actually lending money to other companies to purchase their products. So you were inflating your own revenue by basically extending credit to somebody else. And in many cases, that's not what's happening here. And actually, NVIDIA just put out a 7-page document about that if anybody's interested. But what this all ultimately hinges on is the end user and worker productivity. So we're going to look at that on the next slide here. With worker productivity over time. So anytime you're above zero here, that's the amount of gain in worker productivity on a percentage basis that happened in any given year. And you can see the technological revolutions, internet being the one highlighted here, are associated with large bouts of productivity growth. So, companies' largest expenses are typically their workers. The more productivity you can get out of that worker, the more profits you can receive and the more valuable your company will be. So that's what we saw during the internet revolution. And we think that AI is going to be at least that size, if not much larger, of a productivity boom for companies, because all businesses effectively labor arbitrage. You want to pay your worker slightly less than you made in money, and then you get to keep that spread for yourself. If this all plays out like we're expecting it to, and like these companies are expecting it to, one worker is going to be putting out massively more amounts of productivity and more product to be sold in the marketplace, whether that be goods or services. So this will be a big thing to keep an eye on if we start to see these productivity gains that are promised to us, especially once this agentic era of AI comes in, where it's not so much the chatbot, more so a worker where you can tell it what you need it to do and it will go find the solution for you. And the rapid pace of innovation we're seeing in that space, it is mind-blowing. So I do think we will see some massive productivity gains here that will fund the demand on the end user side, and then we'll see the shift in the valuation going from these kind of interconnected circular financing deals to extending individual companies options to work with your large language model and boost their productivity and really start to see hopefully that earnings growth broaden out from just these top 10 companies to the other 490 because they are still important. We do worry about the concentration risk going on, not only where all the earnings growth is concentrated in a few companies, but all the financing valuations in those few companies. So I think the healthiest thing we can see here is that worker productivity starts to increase. The end user companies outside of just the tech space start to see big gains in their productivity and in their profits, and we see their valuations come up and kind of narrow that divide between those top 10 and the other 490 is what we're hoping for here. And we have seen a little bit of that in the past couple of weeks as some of the valuations have come down in some of the big tech guys, and we've seen some rotation into other industries that are a little more defensive and perhaps had more opportunity to grow because of their low starting valuations and the possibility that they can grow through AI here. So I think we'll leave it with that. Appreciate everybody checking in and taking time to be with us here. We appreciate it. Appreciate your business. Hope everybody has a great Thanksgiving and holiday season, and we will see you next quarter.
We'll see you next quarter, and who knows what we're going to be talking about then. Things are changing fast, aren't they, Sam?
Yeah, it might be like an avatar of us. You'll see.
That's right. But productive avatars, hopefully.
Yeah,
all right, everybody. Happy
all right.
holidays from all of us, and we'll see you on the other side of the new year. Thanks a lot.